Hello and welcome. This is Terrence Berner again. What we're going to spend a minute, about next 15 or 20 minutes going over is we're going to show you exactly what our real estate process is, the process that we go through to, again, acquire a property, go through and do the rehab, how we get a property from point A to point Z. And really what I believe we've created is an opportunity for somebody to own real estate and not have most of the headaches that traditionally you think of. Most of the time, if somebody buys real estate, they've got to figure out what it is that they want to buy. How do they know that it's a good rate of return? If it's a rental property, what does the rehab look like? Do you have teams that you trust in place? How do you get a high quality tenant in there? And then again, at the end of the day, which is what matters most, is what does the return on your investment look like, obviously from investing in real estate. So we'll kind of spend some time and go through those things. So what we'll do is here is really pictures of properties that we have done. You can see there's nothing big and sexy about any of them. Again, these are rental properties, and we'll show you specifically why we do it in Indianapolis, Indiana. Currently, more than 43.3% of all Americans are renters. They're not homeowners. That's over 155 million people in the country. And we'll talk again about one of the markets, Indianapolis, where we believe a lot of people should focus. So why invest in real estate? First and foremost, number one, it creates cash flow. It creates the kind of cash flow where it's passive. You can wake up every single day. You don't actually have to go into work, but the cash comes in obviously from the deposits from the tenants, from the renters. Okay. Second thing is it produces really a unique piece to an overall financial plan, and that is it provides capital preservation. You see, as rents come in every single month and somebody spends that income because they're in retirement or whatever, then the following month that income comes in as the renter pays their rents all over again. What typically happens in the financial world is when somebody retires, I've seen over and over and over again being that I've been a financial advisor for over 10 years, is that people create this pile of money and then they start to spend it down too quickly because they're used to getting 4, 5, maybe 6%. You see, in the financial world, and you can Google this, you can Google the 4% rule. And typically financial advisors talk to people about living on 4% of whatever they have saved. So if you have $1 million, generally speaking, that would produce about $40,000 a year in income for somebody to live on. Well, through real estate, we get that number up to, if somebody invests $1 million, a lot of times that's 80, 90, 100, as much as $150,000 a year, and we have an asset. So somebody can spend $100,000 a year and still have something that is worth, a hard asset that's worth something. The third point is that there can be appreciation over time. Obviously, with rents, you have the ability to hedge inflation. So again, as the cost of living goes up, a lot of times you'll see those rents will increase and your purchasing power will stay the same. Okay. And then the fifth and final thing, this is the thing that I am most convinced, if everyone understood, everybody would own real estate. And again, my disclaimer is that you should consider your own situation and how it makes sense for you. Seek a tax advisor. We are not CPAs or tax accountants, but having a real estate portfolio that is set up as, inside of an LLC, taxes and S corporation, as you talk to your CPA or tax advisor, you'll see all the different tax benefits. What happens most of the time is, think about this. You own a home, so you have maybe the mortgage interest rate deduction. You're contributing to a retirement plan. You have kids living at home. You have all of these things. What they're doing for you is they're bringing tax deductions against your income. So it's lowering the amount of taxes that you pay every single year. Well, what happens when you turn 65 or 60 or 55 and you retire and your home is paid off, the kids are out of the house? By the way, if they're not out of the house, it's your fault, and the government doesn't, the IRS doesn't allow you any breaks for that. Or again, you're retired, so you're not contributing to a retirement plan. So what happens a lot of times is people find themselves in a position where they don't have those same tax deductions. Where if you have an LLC as an S corporation, and again, seek a CPA or a tax attorney, you have the ability to now, you've opened a legitimate business where there's some opportunities for tax deductions and reduce your taxable income for the rest of your life, right? Without having to get up and actually go to work. You've created a legitimate real estate business. Not everyone can own their own home. A lot of times people think, well, why doesn't everybody just own their own home? So here we're going to look at what we call the Great Reset in home ownership. Okay, this is data published by the American Community Survey. This kind of shows the decline in home ownership. You can see we're at one of the lowest levels we've been at in some time, which has really created the perfect storm for rental real estate. Okay, so what is a turnkey property? Okay, so we kind of have the definition up there. One, it's involving the provision of a complete product or service that is ready for immediate use. Now, the thing I've seen over the years over and over and over again is everybody says, hey, this is turnkey, and they make it sound like there are no risks and that absolutely everything is taken care of. And I'm going to kind of show you where some of the risks still are. Again, this is an investment, and with investments, there are risks. What I believe is at the end of, after we've shown you exactly our process, what we do is you'll see that we've significantly reduced that risk. We've provided an opportunity for somebody to own real estate without a lot of the traditional headaches because we take those on. And then, the ability to produce a consistent return as a property stays tenanted, okay? So first and foremost, in our opinion, a turnkey property is a single family home. It's not a condo or apartment. A lot of times we'll do duplexes. Those are far and few between. We'd love to do more of them. But if you get lucky and we have a duplex, then my hat's off to you. But again, a turnkey property, it's a single family home. Second, it's a property that has already been identified and acquired. Okay, so we own the property at Cash Flow Solutions. We don't go to somebody and say, hey, now that we know you want to own real estate, let us go find you a property. We already have properties that are currently cash flowing. So the property has gone through, been rehabbed with a licensed contractor and restored to rent-ready condition. A tenant has been found and put in place, making, really the property in a cash flow state from day one. Property management's in place, okay, meaning that the ongoing collection of rents, and eventually a tenant is going to move out and we're going to need to find you a new tenant. All of that has been taken care of, and we handle all of that. And number 6, the most important thing is it's already generating a passive income. It says zero hassle. Now, there's no such thing as zero hassle, and I'll explain to you what we mean by that here later. Okay, so property management's already taken care of. Our property management company is Invictus Property Management. Okay, everything from how the rents are collected, all of that is done through ACH deposits. So the tenants pay through their tenant portal, and then those deposits are put into our clients' bank accounts about the third week of every single month as direct deposits. Okay, so if there's any issues with anything that goes on with the tenants, you don't have to worry about it. We have staff and people that handle all of that, and really put you in a position where the property is yours, but a lot of the problems that can come with real estate aren't. Okay, so why do we believe the time is now for turnkey properties? We love that saying by it says don't wait to buy real estate when you can buy real estate and wait. Real estate prices they're still low. They're climbing though, right? The second thing that we have here is, if I can get my slides to advance, the economic downturn has created a decline in homeownership, which obviously provides an opportunity for renters. And I'll explain to you here in a second why Indianapolis is kind of its own unique hybrid from some of the traditional big cities like Las Vegas, Phoenix, some of those big hard hit markets through the decline of 07 to 09. Not as many people are able to get homes and mortgages and must rent. The demand for rents in turn has increased. Rent rates are at an all-time high. And this really has created the perfect storm for somebody to buy real estate for a long-term cash flow solution. So Why Indianapolis? It's the number one question we get asked. Why can't I just go invest in my market? And truthfully, you can. The challenge is we follow what we call the 1% rule. So the 1% rule states that, again, if you're going to buy a property for $63,000, or let's say $100,000, that needs to rent for $1,000 a month. So your gross rents need to be at $1,000 a month. So that's first and foremost. We won't buy a property unless it meets the 1% rule. So again, you spend $250,000 on a rental, you need to be able to rent that, in our opinion, for $200 or $2,500 a month for it to make sense. Okay. Second reason is Indianapolis is more of a linear market versus a cyclical market. Per the Bureau of Labor Statistics from 2007 to 2009, at the beginning of the Great Recession, Indianapolis property values decreased only by about 0.4% compared to 25.7% in Las Vegas, 18.5% in California, 16.9% in Miami, and 19.2% in Phoenix. So again, a linear market means regardless of appreciation or depreciation, we want to make sure that cash flow stays consistent. Okay, because again, appreciation or depreciation is really speculative. It's like playing in the stock market. You have no idea year over year where values are going to go. But the one thing we know that we have a lot more control over is the return based on a cash flow scenario. Again, having a renter in a property that's paying rent, we know what expenses are, and at the end of the day, what our projected rate of return will be. Affordable properties. Our average property in Indianapolis is about $67,500, somewhere in there. And so the thing that I love is it allows somebody to own more properties. And the thing I love as a financial advisor is, again, each new property creates its own separate independent stream of income. And the more streams of income that you have, obviously the more bulletproof you are in retirement. And last but not least, Indianapolis is what we would consider a very landlord-friendly state. There's always been a strong rental market, and it's only gotten stronger. Here's rental vacancy rates by region. Okay, so you have the rental vacancy rate in the entire United States is about 7%. The Northeast, I mean, you can see all the different areas of the country. Indianapolis's vacancy rate is 4.2%. What does that mean? That means there's a high level of a low homeowner vacancy rate with a high level of home ownership. So you can see 36% population growth since 1989. It's the #1 city for real estate per Inman News. We'll also show you a Forbes article here in a second that says the same thing. Total population 836,000, so it's not some small little city. There's a lot of opportunity, a lot of people that rent. 75% home ownership rate. This is key. So you don't want to be in markets where it's oversaturated with renters, okay? Because then it creates a lot of competition, and people will, it really becomes a buyer's market in terms of people renting. More homes that there are to rent, more options they have, and just basic supply and demand. And then the vacancy rate is not quite half of what it is across the United States, but extremely, extremely low, which is one thing we want to see. Quick facts about Indianapolis. With a metro area of nearly 2 million people, Indianapolis is the second largest city in the Midwest and 14th largest city in the United States. The city has poured billions of dollars into revitalization and now ranks among the best downtowns and most livable cities, according to Forbes. Major employers. So here's some of the things that really keep a strong rental market. There are currently 3 Fortune 500 companies. You can see some of the names there. 7 high-tech certified technologies, headquarters for the NCAA, the largest single-day sporting event in the entire world, the Indianapolis 500's there. Major distributions from some big-time companies. You can see Amazon, FedEx, Target. FedEx has its second largest hub in the entire country there. Home to 16 universities. Okay, it's the only U.S. metropolitan area to have a specialized employment concentration in all 5 bioscience sectors evaluated and studied. So agricultural, feedstock and chemicals, bioscience related to distribution, drugs and pharmaceutical, medical devices and equipment, and research testing and medical laboratories. So all of these things create there are jobs, and when people have jobs, they can obviously afford to pay rent. Okay, here's a just a snapshot of some of the major employers. Obviously, not even close to all of them. Just some big companies that we knew you'd notice. What does the media say about Indianapolis? You've got Forbes, Times, #1 best city for renters, Forbes, #1 market in the U.S. for real estate, #1 city in the country for good jobs and affordable housing, Investopedia, #4 most affordable city in the U.S., #6. I mean, you can go down and read all of those, for yourself as we've got them up here. But bottom line is all of these factors together have created a great opportunity for rent. Again, here's Forbes article talking about how it's the #1 projected rental market for 2017. And we're not the only ones who've seen the stability and potential of Indianapolis as we've been there over the years, obviously doing real estate deals. Okay. So that's kind of why Indianapolis. Let me go down here and I'm going to show you what some of the deals that we've done look like. So here's an example of a cash flowing property we already sold. So you can see red brick, nice roof. We sold it for $69,000. That included all closing costs. Monthly rents on that were $750 a month. Taxes, insurance, and management was $162 a month. Minus that out, the net revenue to our end client is $588 a month. Annual net revenue is $7,056 with an annual net estimated, again, all these are estimated numbers, at about 10% or a little over was the return on investment. Okay, here's a current property that's on our inventory. This is an example of a duplex. Again, you can see the sticker price on this, purchase price is a little higher, $112,000. That includes all closing costs. Unless it's financed, then there's some other things that come into play. But again, you can see this. Monthly rents are $1,250. Taxes, insurance, management, $216 a month. We have what we call a maintenance warranty. Now, the maintenance warranty on this is $180 a month. What does that mean? $180 a month covers everything with the property minus loss of rent. So let me give you an example. 3 years from now, all of a sudden, an AC unit goes out. That's covered. Needs a new roof 10 years from now. That's covered. A tenant moves out, and we have the cost of what we call a tenant turn, meaning we've got to go in and do some paint, carpet, whatever. All of that's covered under that maintenance warranty. And this is really for somebody, again, who doesn't want to worry about anything that could go wrong with the property. Excuse me. And they just want to collect the rent checks. Under the maintenance warranty, we have staff that goes out to the property every single month and does a check on it, looks at anything that needs to be done, and we do it. Okay. So monthly net revenue on this is $854 a month. Annual is $10,248, and the annual net return on investment is just over 9%. So you can see strong, cash flow. You have some stability because you have two separate doors under $112,000 purchase price, which is why we love duplexes, obviously. Okay. Obviously the safety and stability of real estate. So Indianapolis, why Indianapolis? It offers a stable, consistent rental market, great return on investment, stable economy with high quality renters, in our opinion, and we've created a hands-off passive investment experience. And really, we believe that we've created what most people want when it comes to owning real estate, which is owning the asset, having it produce income, but not having to be involved in all the day-to-day stuff. So here's our warranty program for people that want to protect against time, weather, wear and tear of a property. Instead of about a 10% return on investment, again, these are estimates. Each property can vary. With $120 a month toward the warranty, it brings the return on investment down from about 10 to about 8%. And I know at the very beginning I talked about how people are earning as much as 15%. I'll show you that here in a second. So here's a cash flow analysis. The thing about real estate that I love is you invest in a property at $63,000, factoring no appreciation. After 5 years of a tenant, it's been tenanted, they're paying rent. You'll have earned $31,500 again in projected earnings. So you'll have you'll have an investment where you put $63,000 into it. You've gotten $31,500 back in gain. So now, again, you've made $94,500 investing in real estate, which is pretty awesome. After 10 years, $63,000 in earnings. After 15 years, $108,000 in earnings. And I mean, at the point where you've made $63,000 after 10 years, you've gotten 100% of your capital back out of the investment, right? Which is awesome. Okay, so with these returns, in our opinion, you're outperforming most of the investments out there. And I can tell you, as somebody has looked at thousands and thousands of portfolios, I mean, I'll do a portfolio analysis for you at no cost, and you will see how the power of real estate can really go to work for you. So what are the next steps for those of you that are interested here? We'll send you over a purchase agreement. That'll give you a chance to see what that looks like, all the language. You'll get a due diligence package, scope. You'll get to see the scope of all the renovations on the property, photos of the property. You'll sign the purchase agreement. That'll go over to the title company, and then you'll get an introduction to our property management team. We'll go through and get you the insurance for the property transferred over, and then the title company will close everything. So let me kind of show you an example of what happens when somebody uses, I'm not going to use this here, but let me give you kind of a couple examples. So let's say somebody has $90,000 and, well, here, I'm going to pull up our calculator instead of using this. I'm kind of going to do this on a whim here. But let me show you what this looks like, okay? So let's say somebody came to me and they said, hey, I've got enough where I could do 2 properties and I want to pay cash. Now, for those of you that have IRAs, Roth IRAs, 401ks, you're a business owner and you have maybe a safe harbor, a traditional 401k plan, I can show you how you can direct those assets into real estate. Pardon me. You can direct those assets into real estate and still remain under that umbrella. Okay, do it all the time. But for those of you that that's not your scenario, let's assume that you're using, you want to either buy cash or you want to leverage. And let me kind of show you the difference. So somebody comes to me, they have $140,000, and we take that $140,000, and now we can go buy about 7 properties, right? Somewhere in that neighborhood. 7 properties. Let's say they can buy 7 properties with $147,000. That's 30% down. Okay, with an average cost, and our average property cost here, let me change this, it's $67,500. Okay, so we're right at about $140,000. Okay, again, this is assuming interest rate of 7%, depending on your credit with our lenders. You always have to remember with rental real estate, your rates of return are always going to be a little bit higher. So let's assume again at 7%, we're going to pick it high. So your total purchase price on the properties is going to be $472,500. $141,000 is your down payment. You're going to finance out $330,000. So what that will do, again, these are estimated numbers because these aren't actual properties. We just know what our numbers are to give you a ballpark. The monthly rents on those 7 properties will be approximately $5,100 a month. That's $61,803 a year. Property management expenses a month are $515. Your insurance is $280. Property taxes $394. Your cost of servicing the debt is $2,200. Again, that's principal and interest. So take your total monthly rents, $5,150 minus the expenses, and you have some monthly net revenue of $1,761 a month, or just shy of a 15% return. Now let's say you get a little bit better interest rate, let's say 6.5%. Now you're at 15.8% is your annual return on investment. Let's say that you want the warranty on all of the properties. So we've got 7 properties here. So we've plugged in that warranty. Now you don't have to worry about anything to do with the properties. All of that is offloaded to us, and you're still earning 8.7% like clockwork every single year. So you're earning $12,370 is your annual net revenue on a $141,000 investment is just about an 8.7% rate of return. Okay, let's say your down payment comes in a little lower at 25%. You can see what that does to the numbers. Typically, you're going to be more like 30%. Okay, but that's the power of owning cash flowing real estate, right? Is you over a 20-year period investing $141,000 just from the $22,000 a year that it would generate in income, you'd have $450,000 in total net profit, like clockwork, by owning real estate, right? Look what happens as you start to build your real estate portfolio. Now, let's say that this $22,000, you just let that roll, right? So you pretended like this cash flow didn't come in. Well, what you could do is every single year you could take that $22,000 and that would buy another rental property. So eventually you get to the point where your rental properties, the income from that, you can take to buy more rental properties, and you wake up one day and all of a sudden you have 20 properties and you've got a $5,300 a month passive income flowing in from your investments and just shy of a 16% rate of return. That is the power of real estate. So we would love to, show you more. I know at this point you're probably intrigued. As a financial advisor, I can tell you, maybe right now as of this call, let's see what the date today is. It's August 8th. The stock market's been up the last, last bottom that we had was March of 2009. And the thing about real estate is you can go from something where you're just crossing your fingers investing in the stock market to something that creates a predictable passive income flow for you. And that's what we'd love to do, is help you do that. So reach out to us. We'd love to follow up. There's an email here that you can email over. We'll schedule a call with you. We'd love to share with you more and show you why owning real estate that produces passive income makes a lot of sense. Have a great day.